Hey guys, it's Rudy coming at you live from Palm Beach in Florida. It is Sunday morning. It is November the 12th. We're almost in the middle of November. It's almost the end of the year. What I thought I would do is spend a few minutes and tell you what is in my energy portfolio. Of course, as most of you know by now, I am an energy bull, and the majority of the stocks in my portfolio are energy stocks. I have some other goodies too, like commodity stocks and financial stocks, but by far, the greater majority of my stocks are my equities that I hold in my portfolio are energy type stocks, and I'm going to share with you what they are. Some of them are newer, and some of them have been in my portfolio for a long time. But let's take a look and see sort of what's in my portfolio overall, and I'll tell you what some of my hits and misses are, because like everybody else, sometimes I get it right and sometimes I get it wrong. So these are my positions based on my cost basis. So in other words, how much money I've invested in these respective equities. And what I do here is I make a distinction between my cost basis, in other words, how much my investment is, and the market value, which is what it's currently trading at today. And if I compare the two, then obviously I can show you whether I am running at a loss or a profit. So some of these stocks you'll recognize because I've spoken about them many times, and we have discussions about them in the comments as well. And feel free to comment if you hold any of these or not, or if you're interested in any of them. But down here at the bottom, the ticker symbols show you Alliance Resource, which is a coal company, Blackstone Minerals, which is an energy company, XLE, which is the ETF. And you can see, as I've mentioned many times before, XLE is a parking lot where you can put some cash awaiting investment. So when you get a good deal, like potentially Devon, when it's trading low, I can move some of my XLE money into Devon. And of course, it's difficult to time the market, because remember, time in the market is better than trying to time the market. But anyway, so XLE is my parking lot, and that's one of the reasons why most of my cash, because cash is trash, I'd rather have it sitting in XLE than in cash. But I do hold some cash. In fact, right now, my cash position is larger than what it usually is. I aim for, depending on the account, because they're not all the same, between 10 and 15% cash. Right now, I probably have more like 15 to 20% cash. So I have more cash than usual because I've sold out of some of my positions, mostly financial stocks. So continuing with my portfolio down here at the bottom, Devon Energy. I've made many videos on Devon. Many of you are familiar with Devon as well. So you can see that I've been building a position on Devon as well. Most of the cash outside of XLE has gone back into Petrobras. I'm going to share with you in just a minute why I hold some of these stocks. The next one here with its two ticker symbols is Cameco. It's a uranium company out of Canada. That's why it has two ticker symbols, because you can buy it as CCO or CCJ, depending on whether you're buying it on the New York Stock Exchange or the Toronto Stock Exchange. The third most cash I have invested is in Energy Transfer. One of my smallest investment positions is Occidental, but don't let this fool you, because this is based on cost basis. Enbridge is something I've had in my account for a long time, many years. Enbridge is a Canadian diversified energy company. And last year, I was up about 40% on Enbridge, and it was paying me a dividend of about 5.5–6%. So I cashed out, and now I've been building a position back into Enbridge again because it is super cheap. The two on the far right here, you can probably ignore for the most part because it's mainly play money, but they're very different. GoviX Uranium is a uranium explorer with projects in Zambia and Niger. Now, when your projects are 50-50, Zambia and Niger just recently had a coup, that means 100% of your projects are in Zambia for now. But this is a small position for me, so I didn't invest a lot of cash in it, but I am using some of my play money in GoviX Uranium. The last one here on the far right is Lukoil, the Russian super major. It is incredibly cheap right now, trading at $6.96, but you cannot buy it because it's under sanctions. And for this particular reason, my cost basis on Lukoil is relatively low. Otherwise, I would have bought more. But I am currently being sanctioned by the United States government, so I cannot buy more Lukoil or get my dividend on a regular basis paid to me by Lukoil. If you look at the weighting based on the cost basis, so in other words, if I weight them in terms of percentage, you can quickly see, and I'm going to lump my two of these together here and call this my top 5 in terms of cost basis. So at a glance, you can see, as I just mentioned, XLE is almost 24%, 25% of my current equity investments in energy, followed by Petrobras, which is now my second largest position in terms of my investment, not the market value, right? So in other words, how much of my cash I have put into this particular investment. So 24%, 24.5 XLE, almost 19% Petrobras, followed by energy transfer at around 13% of my invested cash. Devon, 9.4. It's been a loser for most people, but it's arguably a very good time to buy into Devon right now. But I'm going to show you a snapshot of each of these in just a second. And these two I just lumped together because it's sort of a new position for me, even though it's two different equities. Alliance Resource Limited Partners and Blackstone Minerals. These are both limited partners. So if you cannot buy a limited partnership, or if you don't want to because you get annoyed by the additional tax implications if you're a U.S. citizen or a U.S. taxpayer, these limited partnerships are going to send you a K-1 form, which you have to include in your tax filing. For many people, that's more trouble than it's worth. For me, from a personal point of view, I don't mind because they pay such a huge dividend. And in addition to that, they are relatively cheap to buy right now. So I don't mind doing a little bit of extra work at tax time when I get an extra return on investment. So now if I look at the picture a little differently and I say, what do my positions look like based on market value? So I showed you 2 slides back what it looks like in terms of my cost basis. And now I use the same slide and the same configuration to show you what it looks like in terms of market value. And this is a different picture because now at a glance, you can see that Occidental Petroleum is actually in 4th position here. So when I look at it at market value, XLE is still way up front, but Energy Transfer is now my second largest position, and then Petrobras, followed by Occidental Petroleum. And the reason why Occidental Petroleum is now very high in this vertical chart here is because of the gains that I've achieved, because my cost basis on Occidental is $10, and Occidental is currently trading at about $60. So you can do the math on that one quite easily yourself. Devon has been a loser, as I mentioned a minute ago. That's why I put a red block around it here. GoviX has pulled back quite a lot. I bought into GoviX at about $15 cents, and it's currently trading at about 11 or 12 cents. And of course, with Lukoil, as I mentioned, I am stuck because I am being sanctioned, so I cannot buy more at the current low price. So if we flip this and we look at it at market value, then you see the picture has changed quite dramatically. I still have XLE based on market value, which represents around 20% of my portfolio, which looks a lot better in terms of a little bit of portfolio rebalancing compared to how much cash I have parked in XLE right now. However, there's a different picture here because Energy Transfer represents 15% of my portfolio at market value. Petrobras slightly behind that at 14.5, Oxy at 14%. And now look what's happened to Cameco. It represents 10% of my invested capital in terms of its market value. If I go back 2 slides, you'll see my investment in Cameco is only 5.4, but currently, because of the return on investment, it represents 10% of the value of my equities in energy in my portfolio overall. Now, this is an interesting chart because here what I'm doing is I'm showing you a comparison in color-coded horizontal chart, vertical bars, comparing the cost basis to the market value. Now, ideally, what you want to see here is a small little red line like on Occidental here and a large blue line, right? Because if the red portion of the vertical bar is small and the blue portion of the vertical bar is large, that means my return on investment by far exceeds my capital. So I want to see a small red and a big blue. You can see at a glance, for the most part, it's kind of 50-50. I have a couple of losers. They include these 2 little guys on the far right here, GoviX, Uranium, and Lukoil. And then in addition to that, it includes Devon, which has pulled back. But my cost basis on Devon is not too bad. It's currently just below $50. I think it's $49.72 if I average it across multiple accounts, because I have Devon in about 4 or 5 different accounts. And if I average it out, it's $49 and a few cents or something. It's currently trading at $46. I'm only down a little, but it's a negative. And you know what happens when you look at your portfolio? If there's a red a line on your portfolio, it instantly attracts your attention while you ignore the stuff in the green. And that's an important point to make, right? Because if you are nervous when you are down 40% or 20% or whatever the case might be, you should also be nervous when you are up 40% or 20% or so. And there's no harm in taking profit because no one gets poor taking profit. So in other videos that I've shared with you, I said why I was selling Petrobras, which is leading up to the end of last year and early this year. I sold it for a profit. Arguably, I should have kept it because during the year it moved up 35, 40%. So that was bad timing on my side. On the other hand, I also mentioned earlier in this video that I sold Enbridge, which was up about 40%, cashed out, and sat on the cash for a while, parked it in XLE. And when Enbridge got down to about 30 bucks, I bought back into Enbridge once again. So now I'm building that position once more. You can see it over here, kind of 50-50, right? My cost basis and my market value is sort of the same. Anyway, what I don't want to see here is a big red line and a tiny little blue line. I don't really have too many of those. The only one that is really very skew for me is Lockwell, and that's mainly because of government sanctions. If you look at the portfolio overall, and this is an important point because it sort of ties in with Peter Lynch's book, One Up on Wall Street. You don't have to have winners in every single segment, right? So I squared up the bookends here on the left and the right for you because the Alliance Resource Limited Partners and Blackstone Minerals positions are new for me. And when I say new, I mean in the last 3 months or so, I've been building that position. So it's slightly negative for me. One of the reasons why is because about a week ago, they were both trading ex-dividend. And quite a number of people buy into these master limited partnerships to get this huge dividend that they pay. I'll show you more about that in just a second. And then as soon as the ex-dividend date goes by, they sell out of the stock and then just wait to collect the dividend in cash, sort of a few weeks later. So you expect them to take a bit of a dip, and I was buying into that sort of uptrend in the market, but I'm buying these and I'll probably hold them for a long time, maybe at least 3 to 5 years or so, probably more like 5 rather than 3. And of course, on the right, I've lost some money on GoVXX uranium. And with Lockwell, as I've now said 3 or 4 times, I'm stuck. However, on the other hand, there where I park most of my cash, XLE, you see you've got a small little uptick there, right? But that's not too important for me. What's more important is the fact that on XLE, instead of holding cash, I earn a dividend on an ongoing basis of around 3.5%, which means my cash in the bank is basically earning me 3.5%. And that's why it's in XLE rather than cash in the bank. To be fair, though, if you can buy into XLE at $80 or $90 and it goes back up to $100 or whatever, you get the uptick plus the dividend. But these 3 stocks, almost all by themselves, have pulled my portfolio positive. Now, as I mentioned earlier, I have large positions in stocks like Petrobras and Energy Transfer. I have a relatively small position in Occidental Petroleum in terms of my cost basis, but look what the market value has done in order to right-size my portfolio. Now, fortunately for me, these sort of 4 equities that I've blocked out here in green blocks pulls up my entire portfolio. So even though the market is down and energy stocks have pulled back and everything is effectively negative except for those 5 or 7 stocks at the top of the S&P 500 table that's pulling the entire S&P 500 higher. And by means of an example there, if you look at the Russell 2000, smaller companies, they're all trading much lower. But the S&P 500 is doing well, but it's only doing well really because of the guys at the top, the really big companies, Apple, Amazon, Google, etc. The rest of the S&P 500 is not doing well at all. My energy portfolio overall is doing exceptionally well, pulled up predominantly because of Occidental Petroleum, and then of course some huge gains, including Cameco, which is more than doubled since I bought it for around 20 bucks. So let's take a quick look here at the snapshot, and you'll see I've got some sort of, let's call it streetlight type color codings here because I have some green, amber, and red. The price for Enbridge at around $33 is probably arguably a good price to buy right now. However, with a price earnings ratio of around 31, it's not a good buy right now. So I have a red arrow here and an orange arrow here. Enbridge, in theory, should be about a $40 stock and currently is trading way on the left side of the 52-week range. So it's generally speaking, it's cheap. If you're buying into Enbridge, you're not buying into Enbridge now because the price is necessarily low or because it's well priced based on its price earnings ratio. You're buying it because it pays you a dividend of $2.57 on a $33 stock, which is currently yielding approximately 10% on an annualized basis. It's been a very poor performer for the past year. This is a 1-year period compared to the 3 major indices. However, as I said at the beginning of this video, just about a year ago or so, Enbridge was up almost 40% compared to my cost basis, and that's also when I cashed out some of that money. Devon is a buy. So right now, I know everybody is throwing some shade on Devon, and the street is basically hating this stock more than any of the others. Yeah, you know what? All these things are usually temporary. If you can get into Devon at around 45 bucks or even cheaper, that's probably arguably a really, really good deal. It's sitting right here on the left side of its 52-week low. It pays a reasonably good dividend. The earnings have been okay. In the last earnings report just a week ago, they beat on earnings per share, but I think missed slightly on revenue. It's not important. It's only on a quarterly basis. Devon might be a target for acquisition, or they might be looking to merge with someone as well. So there's a lot of moving parts here, but Devon at around $44 or so is a buy. It's been a horrible performer, and in my portfolio in general, in terms of where I've invested cash, this is one of my worst performing stocks, excluding GoviX Uranium and Lukoil for different reasons. Alliance Resource Partners is an absolute steal at 20 bucks. It's got positive earnings. It's got a PE ratio of only 3.85. It pays a huge dividend of $2.80, which is currently yielding 13% on an annualized basis. It's currently sitting just right of center on its 52-week range. And it's been a reasonably good performer before it suddenly quickly crashed before its most recent ex-dividend date, after the most recent ex-dividend date. But Alliance Resource Partners, if you can stomach the additional work at tax time and the K1 and all that kind of stuff, you're okay. I mean, this is a great stock to hold and hold for a long period of time. It's coal, and coal pretty much powers almost the entire world in terms of energy production. Occidental Petroleum, it's debatable whether it's a buy at $60. I know Warren Buffett is buying, and his cost basis is sort of just below $60 overall. I wouldn't buy Occidental Petroleum at 60 bucks. I'd buy it maybe at 50, 55 bucks, but I don't need to. I just hold Occidental Petroleum. And the reason why I hold it is because my cost basis is $10, and it currently pays a dividend of 72 cents, which for me is yielding 7.2% on an annualized basis. I may as well just hold it. And of course, if I sell it, my gains are so huge, then I have to pay a whole lot of tax. So I can use it sometimes to do some tax loss harvesting. So I can whittle the position down over time or so if I have to, but I don't have to, so I just hold it. It's sitting to the left of center on its 52-week range. The PE ratio, I put a red arrow here because it's kind of in line with the S&P 500, which is about 15. So if you can buy it, pretty much anything, look at the PE ratio, Alliance Resource 4, and then on Devon, you don't have a PE ratio. Enbridge is 30, it's too high, right? So currently, Occidental is pretty much just in line with the rest of the market. So I'm not buying it for its PE, but look right at the bottom in the middle. This has now got short interest of over 5%. It's quite high. So there are quite a number of traders expecting Occidental to pull back even further from where it is right now. It's also been an underperformer, like most energy stocks compared to the indices. But for me, this is a hold. And the primary reason why I hold it is because my cost basis is low and it's yielding me 7.2%. So it's basically like a high interest savings account, nothing more, nothing less. Petrobras, a very, very different one though, right? I hold Petrobras A, and the Petrobras A is the preferred shares. That also means that they are non-voting shares. I have been buying Petrobras, and I started buying PBRA at around $13.20. It's currently trading at around $14.20 or so. I put an amber block around this one because I think the price is okay. Based on its PE ratio, it's good. The dividend, of course, is massive. So if you're a dividend investor or you need fixed income or whatever, this is a beautiful picture. It's paying a $3 annual dividend approximately, because it varies, yielding currently 22% on an annualized basis, and it's easily outperformed the indices. It is trading a little bit high though. That's why I put this red arrow here. But offset that against the price of around $14. Not too bad. This has got some run rate in it and could possibly go to $15, $16. I don't expect it to go to 20 or 30 bucks. This is my parking lot, XLE, right? So as I showed you at the beginning of this video, this is where most of my cash awaiting investment is usually typically parked. Why this particular one? So in the first place, right now, the price is okay. It's pretty good at $82.75. In other words, instead of having $82.75 cash in the bank, I'd rather have one share of XLE. It's an ETF, so it's an exchange-traded fund. The bulk of the assets in this fund is my apologies, is Exxon and Chevron, approximately 20% each. So almost half of XLE is Chevron and Exxon. It's kind of like the proverbial safest houses, from an energy point of view. Both those companies pay a high dividend as well. So for that reason, along with some other stocks in the portfolio in the top 10, it actually yields 3.5% right now at $82. So this is, for me, once again, a savings account. It's not a high interest savings account like Occidental, but it pays a 3.5% return on investment, and the expense ratio is really, really low, right? So 0.1%. So if you knock that off the distribution, then I'm yielding approximately 3.5 on XLE. It's currently sitting left of center on its 52-week low. I don't know. Nobody knows where this is going except Jim Cramer, perhaps. But this is a large value stock. It's relatively low risk. And if you're not sure what to buy in terms of individual energy stocks, and you're afraid that you might lose some more money on things like Devon Energy or Occidental Petroleum or whatever, you can always buy XLE and just sit on it for a while. And you don't even have to sell it at a loss ever. You can just wait. Eventually it'll be profitable again, and then you can sell it out. And in the meantime, you're earning 3.5% interest on your investment. Energy Transfer has been a great performer for me, and I'm nearly done here. I put the current price, the $13, in amber because it's sitting just right of center in terms of its 52-week range. This is not a $13 or $14 stock. It's more like an $18 stock based on a discounted cash flow model. But the problem with discounted cash flow, or DCF, is that there are so many variables included in that model that it is very, very easy to be wrong. In fact, your chances of being wrong are better than your chances of being right when you do a discounted cash flow. But I'm okay with Energy Transfer at around $13, $14 or so, especially because it is currently paying a dividend of $1.25, which is almost a 10% yield on an ongoing basis. So in a very volatile market, I'm very comfortable to just hold Energy Transfer. I also put an amber arrow next to the PE ratio, 12.31. 12.31 is, again, just sort of close in line with the rest of the market. And there are many exceptionally great energy stocks that you can buy with PE ratios way below 10, like Alliance Resource Partners and Blackstone Minerals. Energy Transfer has been performing sort of alongside the indices, pretty much the same as everything else except for the NASDAQ. But the NASDAQ, which is tech heavy, has also been lifted by some of those tech stocks. Now, Cameco has been my best performer over the past year, which is wonderful because you can see it on the far right here on this black line. Cameco has just easily crushed the indices, and it's been a great performer for me. Would I buy Cameco right now? I don't think so. I got into the stock at around 20 bucks, and it's currently trading at 42. So I'm up way over 100% on my cost basis. I didn't buy it for its dividend. I bought it because it's a uranium play. And of course, the price of uranium has just spiked. So it's gone nuts, right? But the PE is horrible, 91. You could argue that Cameco can go from $42 to $100 here. Nobody knows. I certainly don't know, but I'm comfortable holding it. Obviously, I have a huge gain, so if it pulls back a bit, I'm still okay. It is a large cap growth stock in Canada, but it's trading way to the right? It's at its 52-week high. That's where it is right now. So you have a 5%, 5.4% short interest here, so people are expecting it to pull back a little bit. It pays a small little dividend. I didn't buy it for its dividend either. I bought it for the uranium play. And I have a few uranium type stocks in my portfolio, including GoviX Uranium, which I shared with you earlier on, which is an explorer. Right now, if you are investing in uranium, Cameco is a relatively good bet, and it's sort of safe place to put money if you want to invest in uranium. It's one of the largest producers on the planet. It's in a favorable jurisdiction, which is Canada, instead of Kazatomprom, which is in Kazakhstan, and right next door to Russia, and sandwiched sort of in that conflict zone of Russia, Ukraine, etc. So if you want to invest in uranium and you don't want to take too big a chance, you can buy an ETF, or otherwise you can buy Cameco and maybe park some cash there. That's an overview of my entire energy portfolio in terms of where we are today. As you can see, I have a basket which is somewhat mixed. It's pipelines, it's diversified, it's upstream, midstream, downstream. There's marketing and sales in there as well. You know, companies like Energy Transfer also own Sunoco, which is gas stations across the United States. I think they have about 3,000 gas stations. Companies like Enbridge is an interesting company. It's oil and gas. They own pipelines. They are also the utility that provides natural gas for heating and cooling for the province of Ontario, where almost a third of Canadian people live. You know, so it's a very diversified energy portfolio. There are a couple of things I don't have. So I don't really have much in terms of drilling, and I don't have tankers and things like that. Some of those have been great place for other people too. And if you hold some of those, you can let us know how you're doing and what you think. Anyway, as usual, I welcome your comments. And if you want to sort of shoot any of these down in flames, or otherwise, if you want to share some of your insight with us on some of the stocks that I've discussed, or if you have something better, share that too in the comments, and we look forward to chatting with you. So for now, this is Mr. Oxy signing off, saying have a great day. Bye-bye.